Welcome to SB Talks. Today is Monday, June 2nd, and I am joined, as ever, by our Chief Investment Officer, Nick Ryder. Welcome, Nick.
Thank you, Vinny.
Now, today, Nick and I will be discussing the latest RBA rate decision, the broader health of the Australian economy, and one big, beautiful bill. Welcome to all our listeners. The last time we recorded was the day before the Reserve Bank meeting, and we ultimately got what we expected, a 25 basis point cut. But from the minutes, have you learned any more in terms of what the RBA's position is and, more importantly, their potential direction of travel from here?
Yeah, I mean, I think it was a very interesting post-meeting press conference from Michelle Bullock. It was quite a change from her presentations earlier in the year, where she really was quite dovish, I guess. You know, they'd sort of abandoned a lot of the dialogue about the economy, you know, having too much demand relative to supply, concerns around the tightness in the labour market and what that might mean for wages and therefore for services inflation and things like that. She really had abandoned a lot of that rhetoric.
What do you think the driver of that is?
Well, I think partly it's, you know, the tariffs, the Liberation Day tariffs has just created a lot more sort of economic uncertainty globally. So she used the word, the word uncertainty was overused. It was used a lot.
Perhaps deliberately used excessively?
Yeah, it was used a lot. And I think they are of the view that inflation is now sort of where they want it to be. So it's within their target range of 2 to 3%. And they have a lot more confidence that it's likely to remain there sustainably. So,
what's your take on that? I recorded last week with Ian McFarlane. He felt confident that, I don't want to say the inflation war is won, but the greatest threats or risks are probably behind us.
Yeah, I think that would be a fair assessment. I'd probably take the same view. Depending on how you look at inflation, it's definitely within the 2 to 3% band. We did get the monthly inflation numbers last week for April. It did show inflation or trim mean ticked up a little bit from 2.7 to 2.8. So it's not, necessarily coming right back to the middle of the target range. But then, other measures, like headline inflation are definitely around there. So I think it's in a good place. Obviously, some of the inflation has been supported by government electricity subsidies and rent subsidies and things like that, which could roll off at some point, seeing inflation rise again. But I think if you look through all of that, it is kind of back where the RBA wants it to be.
And probably painting a picture of the economy's not necessarily roaring.
No, and so we got a new set of forecasts from the RBA. Every quarter they put out their statement on monetary policy that contains a new set of forecasts. And they actually had a slightly slower economy, the consumer fairly weak. Even then, they still expect consumer spending to expand at a reasonably much better than it has been recently. So I guess there's some question marks about that, particularly in light of some of the retail spending numbers that we've seen last week. And they see unemployment a little bit higher than what it was. So I think it goes up to 4.3 in their forecasts versus 4.2 previously. So a slightly weaker economy, slightly higher path for unemployment. So I guess that sort of supports their more dovish view and therefore the need to cut rates. There was some changes in the language around sort of how restrictive policy is. It did indicate that maybe they thought the rates, even after the cut to 3.85, are still fairly restrictive. Yeah. And so, there was some discussion, some indications around where their neutral rate is, and that's a little bit lower than
previously thought. Yeah. So the neutral rate, that's the point where they think they need to have rates to neither be stimulating or having a foot on the brake on the economy. And where do we now think that that's leaning towards?
Well, most economists had it around 3.2, 3.25%. I think that's the view in the broader market. But the RBA, they have a bunch of different forecasts, and theirs is, I think, at 2.7. Now, there's a big sort of range around that. So no one really knows where this number is, but it's at 2.7. That's quite a lot lower than kind of where it was previously, using their modelling.
And that is significant when we look at the longer term outlook.
Yeah, so we now have another 73 basis points of cuts between now and the end of the year. So that's 3 rate cuts, taking us down to 3.1%.
Is that a fairly consensus view when you look at
that's the market view?
Yeah.
I think, I can't recall all the sort of houses, but I think 2 to 3 rate cuts is pretty well baked in by most economists for the rest of the year.
Yeah, and when I guess you take a few big factors at play, we've talked here about, I guess, population growth and how that sort of helped prop up the economy. Government spending, particularly even some of the state government spending, when you strip a lot of that out, I guess the economy is showing the consumer weakness that we're seeing.
Yeah, so
these rate cuts are needed.
Yeah, last week we got retail sales for April negative 0.1%, and that's in nominal terms. So, now there could have been some distortions around the timing of Easter and warmer weather, which impacted clothing sales and department store sales. So, maybe there'll be a payback in May. But that's certainly not showing a consumer that's willing to spend a lot.
Mm-hmm. All right, mate. Feels like sometimes this is the Trump pod or the tariff pod. But anyway, we've got a new angle today. It is one big beautiful bill. Tell us more, Nick.
Yeah. So over the last couple of weeks, we had the U.S. House of Representatives approve their version of the One Big Beautiful Bill, OB3 for short, which has, it has some of Donald Trump's promises on no tax on tips, no tax on overtime, some state and local tax offsets, as well as an extension of his 2017 tax cuts, which those on their own apparently would account for about $5 billion over the 10-year forecast period. So $5 billion of tax cuts that are baked in. So extending those adds to the deficit.
Stimulates the economy, but exacerbates the deficit.
It basically keeps the tax cuts, the same tax rates in place. But as we know, there's a big problem with some of those tax cuts. And so there's some offsets to Medicaid eligibility. So all up, depending on who you talk to and which estimate, it adds about $2.5 trillion to the debt and deficits over the next 10 years. So not good.
Doge has got a lot of work to do.
Doge didn't really, by all accounts, do much. Now, that said, kind of in the 2026 year, that those tax cuts and the net impact is about 0.9% of GDP, so it would be expansionary next year. But then, of course, we have the tariffs, which aren't baked in. So the tariffs, at say 13 to 18%, depending on where they kind of land at the average, is a tax. It's effectively a VAT, or tax on consumption, and that would reduce GDP by about 1.2%. So you've got to kind of take the two things together and say, well, yes, they're adding to the deficit, which the bond market hasn't liked, but their tariffs are collecting revenue. So, and then they're not baked into the OB3 bill.
Assumptions yet. And I guess, sorry, go ahead.
Well, that's the House version. It then has to go to the Senate for reconciliation, and the Senate might then have their own changes, and then that might necessarily have to go back to the House. So they have to kind of agree across the two houses.
And there's certainly some of the Republicans that have serious concerns regarding the fiscal responsibility side to this.
Yeah. I mean, in the past, it was the Senate that was more fiscally conservative. But maybe not this time. Maybe they'll just sort of sign off on this. Now, of course, all of this, they're trying to get all this done by sort of early July because the debt ceiling, they'll hit that in August. So they want to also raise the debt ceiling by, I think, $4 trillion to accommodate all of this.
So we've got this still unfolding.
Yeah.
We have obviously the tariff picture evolves daily, certainly weekly. We've had a doubling of some of the steel tariffs, potential deals on the way, UK deal done, but many others mooted or discussed, but we remain probably no clearer.
Yeah, and then we had last week the US Trade Court blocked a lot of the Trump's reciprocal tariffs, those under the International Economic Emergency Powers Act, basically saying that the president had overreached, and therefore, that will get appealed, and those tariffs are still in place while the appeal gets heard. But it just adds another layer of uncertainty, and I suppose for those countries looking to negotiate, maybe give them pause and think, well, maybe the courts will reject some of these tariffs. So now Trump can still get things like the steel and aluminium tariffs because they're under a different law. So maybe that is why he's pushed hard on those particular tariffs.
And we've seen US earnings season, so anything catching your eye there?
Yeah, it was a pretty good earnings season. I think I've spoken about it on prior podcasts. The numbers came in pretty strong for the first quarter. The most recent sort of notable company to report was NVIDIA, obviously closely watched by the market. Pretty strong result in Q1. They did, I think it was 44.1 billion of sales for the 3 months. That was better than expected, and up 69% on the same quarter a year ago. Wow. So it just shows you the phenomenal growth in chip sales. That said, they're pretty cautious about the outlook. You might recall that the US administration has tightened what kind of chips can be sold into China. So previously they were able to sell the H20 chips. Now longer those chips are no longer being able to be sold there.
Which were really specifically designed to marry up to what the restrictions were for that market.
That's right. And so NVIDIA's had to write off $5.5 billion of inventory.
It's a lot of money, but put that into some context for us.
Well, $5.5 billion out of, the size of, it's a $3.4 trillion company. It's a lot, but in the scheme of things, not so much. But China has been an important market. I think 13% of their sales go to China. So they're going to have to create a new chip, and even, a more basic one. And that's going to affect their sales. So they did warn about that there would be a hit to sales in the second quarter as a result of some of those changes. So, that said, the stock's up 3% year to date. So, market seems to have, got over the fears around DeepSeek and China and all that sort of stuff. And
given the run that it had previously, and then some of the headwinds it's faced this year, it's probably doing well just to stay positive. Anything else catching your attention? Either in the past or coming up?
Yeah, so, it was a very strong month for equities. So we had global equities rose 6%. That was the strongest month. That was in May. That was the strongest month since November 2023. So obviously, a big recovery on the back of the pause in tariffs and particularly the China-US ones. So I think that was,
a bit of a relief rally.
Yeah, a bit of a relief rally. In terms of what's coming up, we're getting the GDP figures for Australia on Wednesday. I expect it to show 0.4% growth for the quarter and 1.5% for the year. We'll see whether the economy grew that quickly. It's been fairly sluggish, so that's sort of a key thing for me.
Excellent. Great fly around the world as always, Nick. Thank you very much. And thank you to all our listeners.